Hello, my name is Dr. Richard Erickson. You can call me Dr. E or Rich, whatever makes you feel more comfortable. But I'll be your instructor for corporate finance. Hopefully you all have had a chance to get this book, Essentials of Corporate Finance, by Ross, Westerfield, and Jordan, and have begun reading it, and hopefully you've got the first 3 chapters well in hand. Just a quick note about myself so that you know who your instructor is. I've been teaching at Judson University since about 2005. Prior to that, I was a professor at Northern Illinois University in DeKalb, and before that at Wheaton College in Wheaton, Illinois. In addition to the teaching that I've done for the last 25 years, I've also been an entrepreneur for 20-some years in addition to that. I have been a former stockbroker for Merrill Lynch, money manager, and currently investing in real estate in the Rockford area here, and also selling commercial insurance, as well as teaching here at Judson. I've got a special affinity for you folks that are in the online program and the coming back to school, college as adults, because I did a lot of my work at night as well. Finished my MBA at the University of Chicago in 1983, and then went on to do the doctorate in finance at University of Illinois Chicago, and finished a doctorate in instructional technology at Northern Illinois University in DeKalb. We're going to be looking at corporate finance, and as always, these courses being the compact nature, just try to cover a subject in a very short amount of time. So it requires a lot of discipline on your part. You autodidactics need to be able to make sure that you stay current with the materials. If you have questions about anything, please refer to the syllabus, refer to the spreadsheet that I've posted that contains the due dates for all deliverables and their point values. And I've also given you my phone number, 815-566-6140. If you have any questions or you're not sure about something, please give me a call. Stay current with your postings on the discussion board, and remember to follow all the guidelines in the syllabus for your postings. We're going to be looking at the first 3 chapters today, and just kind of do this flyby 40,000 foot level overview of financial management. Chapter 1 is our overview of financial management, and it also starts with the notion that there are 4 basic areas in finance. These include corporate or business finance, and investments, financial institutions, and international finance, which is really just specialized applications of the original 3 areas. These areas of finance really form the basis for some tools to make financial decisions. We're faced with making decisions under uncertainty, and there are 3 basic questions that business finance or corporate finance attempts to answer. The first one is, what investments or projects should we take on? The second is, how will you raise the money for these things? And finally, how are you going to manage the day-to-day operations of your firm? Question number 1 is really about capital budgeting. Capital budgeting involves evaluating the size, the timing, and the risk of future cash flows. The key tool here we're going to look at is net present value, which attempts to take future dollars and bring them back into the present to show what they're really worth. You'll be quite familiar with the concept of net present value, if you aren't already, by the end of this course. The second question of how we're going to raise the money for it has to deal with capital structure. What's going to be the mix of debt and equity? How are we going to structure our firms? What's the optimal choice for our firm? There's a fundamental accounting relationship, a formula that says assets are equal to liabilities plus equity. That is to say, the assets, the things that have value that make up our firm, have to be paid for somehow. And there's 2 ways to pay for them. You can either put up the money as an owner of the firm in the form of equity, or you can borrow the money, and which creates a liability. So these 2 types of financing of assets make up the capital structure of a firm. The final question, how you're going to manage the day-to-day operations, is called working capital management. Essentially, it's taking a look at the short-term assets management of your firm. Short-term assets are those assets in a firm that have a life of 1 year or less, or can be converted readily to cash. Things like cash or securities or accounts receivable or short-term notes. These are all ways of acquiring short-term assets. The next thing the chapter talks about is how you organize your firm in terms of what kind of entity shall we establish for our firm. There are three major types of entities, and of course permutations on all of them. The first is a sole proprietorship. This is where Joe Incorporated, basically Joe as an individual, starts up his business and holds the business in his name, and it's the easiest form, it's the simplest form of company structure, and yet it contains some problems. Some of the problems are included: how do you transfer ownership? How do you have fractional ownership? How do you have a life that goes beyond the owner's actual life for the firm? The liability as an individual is 100%. You're liable for your personal debts plus the firm's debts as well. So while most companies start out, or a goodly number of them start out as sole proprietorships, they oftentimes migrate to another form of ownership. Similar to the sole proprietorship is the partnership. Partnerships are where more than one individual get together and form a firm and start operating. This contains some of the same problems, though, that the sole proprietorship, in terms of the ability to transfer ownership or partial ownership of a firm, as well as the unlimited liability that the partners have. Now, there's a special type of partnership where you have a structure that includes a general partner and limited partners. Limited partners in this situation are only limited in terms of liability to the amount of money they put up. They can't lose their own house or things beyond, assets of their own beyond the actual money that they put into the partnership. Whereas a general partner is, again, liable for personally as well as the business debts. The final form of corporate structure, or final entity form, is called the corporation. The corporation is a legal entity that creates, much like an individual, a separate person or a separate entity. This has a number of advantages as a form of ownership, and therefore most large companies are structured as corporations. The corporation has, first of all, limited liability. The creditors of a corporation can only go after the corporation's assets. They cannot attach the personal assets of the individuals in the corporation, or the individual that own the equity in the corporation. They're only liable to the extent of the equity that they've invested in the company. Secondly, corporations exist in perpetuity. That is to say, they have no natural life which they die out at, and therefore they're going to go on beyond the life of an individual founder. In addition to that, it's easy to transfer ownership, fractional ownership. It's done in the form of shares, which represent a residual claim on the assets of the firm. So these three structures exist. Corporations also have different types of manifestations as regards to tax treatment. The C corporation is the typical corporation, and the corporation's earnings are taxed at the corporate tax rate. There are two other forms of corporation. You can make an election to have your corporation pass through the earnings to the individual who owns the corporation, or the individuals, plural, that own the corporation. And that's a sub S corporation, and a newer form called the LLC, a limited liability corporation. Now, these things offer some of the main protections of limited liability and perpetuity existence, but they also get taxed at a different kind of a level. Since the recent tax changes in 2018, where corporate rates have been changed to a flat 21%, it'll be interesting to see how many people choose to elect sub S and LLCs as a corporate entity form in the event that their own personal tax rates may be higher than the corporation's tax rates. One of the big problems historically has been, though, the treatment of dividends for corporations. It's called the double taxation problem. The double taxation problem exists because Corporate earnings are taxed, and then after the taxes have been paid, from the residual earnings, or what's called retained earnings, you can pay dividends. That's the only way to give money to an individual who owns stock in the company, and that is through the use of a dividend. Now, dividends get taxed once you receive them as an individual, currently at a 20% tax rate. But what you end up is having two taxes paid, first on the corporate side and secondly on the dividend when it's paid to an individual. So this double taxation problem is what led to the sub S and the LLCs. The other question that we need to answer with corporations, and that has to do with what's called the agency problem. There are the owners of a corporation, i.e. the stockholders, and then there's the people who work for the corporation, who run the corporation. And as a rule, they're both trying to do the same thing. That is to say, maximize their own personal utility. But unfortunately, sometimes these personal goals or objectives are in conflict. The owners want to have the most possible return from their work. They would rather the employees worked for nothing or as little as possible, worked hard, long hours, and had very few benefits. On the other hand, the employees of the corporation want a corporate jet, a retreat in the north woods for summertime, and a place in Hawaii for their wintertime getaways, and all kinds of perks and high salaries. So we have this conflict, and it's commonly known as the agency problem. One of the traditional approaches to solving the agency problem has to do with an attempt to align the benefits or the objectives of the two different parties by offering stock incentives in the form of dividends or stock options to the employees, mainly the key employees of a firm. And so in this way, the managers of the corporation will earn more money if the stock prices go higher, i.e. if they run the company well and if investors think their prospects for the future are better. And this would also make the owners of the stock, the owners of the corporation, the stockholders, also happy because their value of the firm has gone up. In general, though, we arrive at the goal for financial management. And the basic goal of financial management is to maximize the value of the firm. This may look similar to maximizing the stock price, but in essence, though, we're trying to maximize the value of the firm. One other thing we do need to mention is the fact that in an attempt to maximize the value of the firm, we have to be sure that we don't operate in an unethical manner as well. Firms have obligations, legal obligations, but there are also a discussion about whether or not they have social responsibility obligations or ethical responsibilities. At Judson College, we're unashamedly a Christian organization, and we believe that God calls us to a higher standard than the law or social norms might require, and that is to treat each other as people that God loves, and that we have a higher standard of conduct. But government has attempted to also instill some ethical guidelines and ethical controls on companies, most notably in a bill known as the Sarbanes-Oxley law that makes the top corporate officials responsible for the things that they do as a corporation. And so you've been seeing heavy fines and even in some cases imprisonment of corporate leaders who have gone astray of the law in operating their businesses. So, to sum up, the last point that was mentioned in the chapter talks about the existence of financial markets. Markets are places where buyers and sellers get together, and financial instruments are bought and sold every day in regulated markets that exist in basically two flavors. The first market is called the primary market. Primary markets are where the first time issuance of a share of stock or a bond offering are brought to the marketplace and made available for buyers. After and In the case of stocks, they're called initial public offerings or IPOs. You might have heard of those. Well, the primary market is just a one-time uh, place where a financial instrument is traded. Thereafter, it's still possible to sell that ownership and that financial asset in what's called the secondary markets. The secondary markets include things like the New York Stock Exchange or various regional exchanges throughout the country and actually throughout the world. So secondary markets are where financial instruments that have been already through the financial or the original primary market are now brought to sale or for purchase in what's called a secondary market. And there's lots of them over-the-counter stocks, the NASDAQ, you've heard of that, as well as various stock exchanges. Chapter 2 deals with financial statements, taxes, and cash flow. It turns out that this topic is actually the subject of an entire course that's taught many times. In fact, Judson offers a course in financial statement analysis. And while it's a complex subject, it's going to focus on looking at a number of things here. The main financial statements that we're going to look at are called the balance sheet, the income statement, and the cash flow statement. The balance sheet is like a snapshot or a picture at some point in time of the firm. Again, referring back to that basic fundamental accounting formula where assets equals liability plus equity. You'll see these three headings show up on a balance sheet. And on the left-hand side of that equation are the assets. And so the balance sheet will list all of the assets of the firm. And these assets had to be purchased or paid for one of two ways: by borrowing the money, which is the liability side of that equation, or by owners putting up equity in the firm, buying stock or buying proportional shares of the company, and that's the equity part. Equities in corporations are often called a residual claim on the assets. That is to say, in liquidation of a firm that's going bankrupt or being liquidated for other reasons, the assets and their value are sold, and the money first goes to pay off the debt holders, the bond holders, the people who have lent money to the firm, the corporation. And then after all that is done, the shareholders, the stockholders, have a claim on the residual assets, what remains, the value that remains. And if in fact there are more liabilities than there are assets, then the stockholders have nothing to gain, and they just have lost their investment. Okay, a few terms that we need to understand here that are brought up at this point in the textbook include the notion of net working capital. Net working capital is simply the difference between current assets and current liabilities. And the reason why net working capital is an important concept to understand is because in order to get firms to loan you money or extend credit, they want to be sure they have a good chance of being paid back. And your current liabilities include things like your rent, your utilities, your payroll, etc., that's owed. And the current assets are things like your inventory, your cash, your securities, your short-term investments. These all give us the ability to meet the current obligations. It's the way that we can continue to operate our firms. Liquidity is a hallmark of current assets, and liquidity talks about the speed and the ease with which it is to convert an asset into actual cash. Now, for instance, a building that you might own as a corporation is an asset, but it's not considered a current asset. Sure, you could sell it tomorrow for $1, but that's nowhere near its real true worth. Liquidity means that it has to be able to be converted into cash quickly and close to its real value in the amount of cash that you get for it. The debt versus equity idea has to do with what's called the capital structure, as we've mentioned already. And the more debt that you use for the firm, the greater your use of leverage. Leverage is a two-way sword, a two-edged sword. Imagine, if you will, when you purchase a house, if you paid all cash for a $100,000 house and the real estate values in that area rose by 10%, you could sell it for $110,000 and make a $10,000 profit, which is a 10% return on your investment. But if you had borrowed all that money and say you only put down $10,000 and borrowed the rest, and the next day somebody offered you a 10% increase, $110,000 for the building, you would have a $10,000 profit minus any interest you might have, which is double what you put up, i.e. 100% rate of return. So when things are going well on the upside, leverage is a great thing because it enables you to get much higher rates of return than you otherwise would have. The other edge to that double-edged sword, however, is that when things go down, if you pay $100,000 for a house and it goes down to $90,000 in value, you've lost 10%. But if you only put in $10,000 and you borrowed the rest and it went down $10,000, you lost 100% of your equity. So the debt versus equity question is constantly faced by businesses when they attempt to determine how should we structure our company, how much money should we put up in the form of ownership or stocks, and how much of the company should we put up in the form of debt, how much should we borrow. Another concept you need to understand is the difference between market and book value. Corporations have regulations that require them to follow certain accounting principles, generally accepted accounting principles, and the way assets are recorded in accounting is that you base the value on the historical cost. Now, historical costs and current market costs are entirely different things. If you bought an asset, you bought a home in an area where prices were going up, and you paid $100,000 and you put it on your books at $100,000, a year later, it might be worth $120,000. Yet it would still be on your books. The book value would still be $100,000. And if it's an asset you're depreciating, say it was a factory building that you had purchased and you were writing it off, or in my case, I own rental property here in the Rockford area, I write off, I depreciate the value of my building over 27 years. And so each year I write down the book value of my asset. Hopefully the asset is still going up. Now, unfortunately, in Rockford, for the last 10 years or so, that has not been the case. They've been going the other direction. But nevertheless, you need to understand that book value and market value are two different concepts. In the end, the value is represented more accurately by the market value. Back when Humphrey Bogart was making movies, he got $50,000 for making a picture. Somebody asked him, "What makes you think you're worth $50,000?" And his reply was, "Because I can get it." The truth of the matter is, something is worth what somebody else is willing to pay for it. Currently, taxes in the corporate world have just undergone a big reduction. They were historically in the 35% area here, and with the recent tax bill that was passed, corporate tax rate in 2018 is now down to 21%, and it's a flat tax. It's not a graduated tax, although there are some potential alternative minimum tax things that might adjust it. And in the case of Illinois, we have a state corporate tax of 7.75% in addition to the federal corporate tax rate of 21%. When we had graduated taxes, you had to be careful to distinguish between your average tax rate, i.e. the actual taxes you pay divided by your income, versus the marginal tax rate, which was the tax rate you would pay on the next dollar of income, which was represented by the bracket that next dollar of income puts you in. But now with a flat tax rate, it's a little simpler to calculate. The last financial statement that we're going to look at is the cash flow statement. And the cash flow statement is essentially one of the more important ones because that talks about reality, what's really going on. In its simplest form, it's the difference between the cash that comes into a firm in a year or whatever time period you're looking at, and the cash that goes out. That's the net cash flow. And the cash flow statement differs from the income statement in a significant way, and that is to say, the cash flow statement includes non-cash items, has non-cash items added back in. On the income statement, you're looking at a formula that says you take your revenues, you subtract your expenses, and that's your net income. One of the expenses you're allowed to take in business is called depreciation. The depreciation is based on the idea that physical assets wear out over time. The truck that you bought brand new this year, 5 years from now, won't be worth as much because it's been partially used up. Buildings deteriorate and need repairs. So you're allowed to expense a proportion of the cost of physical assets over time, and this expense really doesn't come out of your pocket. It's just a notation on your statement that you send to the government when you're calculating your taxes and your income statement. But in reality, you actually have more dollars than your net income. You have your net income plus all the non-cash items, and the principal non-cash item that we're talking about here is depreciation. So the actual formula for cash flow is calculations are the earnings before interest and taxes plus depreciation minus taxes, and that's your operating cash flow. And the operating cash flow is what businesses really focus on in many cases, because this tells you what kind of cash you have available to pay bills, to expand, to take on new projects, to grow your company. Another concept you need to understand is the difference between working capital, which is the net change in working capital, which is the end net working capital minus the beginning net working capital. And the other one you need to look at is capital spending. Capital spending is the end value of your net fixed assets minus the beginning net value of your fixed assets plus depreciation. And so oftentimes firms want to zero in a little closer on something that's called the cash flow from assets, or what's called free cash flow. And that's basically your operating cash flow minus your net capital spending minus your changes in net working capital. Or another way of looking at that's just like your assets equal liability plus equity. Your cash flow, your free cash flow is equal to the cash flow to stockholders plus the cash flow to creditors. And the cash flow to creditors is interest paid minus the new net borrowings, and the cash flow to stockholders are the dividends paid minus the net new equity raised. So you can use your cash flow statement to mirror the accounting equation of assets equal liability plus capital. And you can focus on what kind of cash the firm has to operate with. In my case, as a real estate investor here in Rockford, I show net losses every year because of depreciation, the ability to write down the apartment buildings that I purchased. On the other hand, my goal is to have positive cash flow so that I get cash in my pocket to buy donuts with, and I pay less taxes to the government because I'm showing an actual loss on my income statement. Nice work if you can get it. Okay, finally, Chapter 3 looks at working with financial statements. And again, as I mentioned earlier, financial statement analysis is an entire course all by itself. And at any rate, though, we're going to do a 40,000-foot flyover on this topic and take a look at working with cash flow statements. The goal of financial statements is to give you a clear picture of a firm's true value and economic health. And essentially, we use financial statement analysis in two ways. We do what's called cross-sectional analysis, where we compare different firms' financial statements and ratios. And we also look at it longitudinally. That is to say, we look at the same firm over time. So cross-sectionally, we are able to compare our firm to other firms in our industry. And internally, we can look at how our ratios have changed over time in our firm. Investors looking to purchase stock in a company will look at statement analysis and look at ratios, and they'll compare how the particular firm they're interested in looking at compares to other firms in their own industry. It wouldn't make sense to compare a grocery store to an auto manufacturer because they're in different businesses altogether, and therefore their ratios are going to look different. They'll have different values to their statements. Internally, we use ratio analysis and financial statements analysis for evaluating performance of our managers and also for planning for future events. We externally, again, potential creditors will look at statements and look at ratios to determine whether or not the firm is worthy of loaning them money, if it's going to be a safe investment. And as I mentioned before, investors will look at firms' statements and analyze them as to whether or not they represent a potential good investment or not. Companies will look at the statements of potential customers to see whether or not they're worthy to extend them credit, or they might look at suppliers to make sure that the supplier is going to be around long enough to make it worthwhile establishing a relationship. They use it to evaluate competitors to see how they're doing, how their company stacks up against their competitors. And again, this benchmarking is often done against the leaders in a given SIC code or industry segment. Well, one of the most useful tools in making these comparisons has to do with common size balance sheets. Because of the different sizes, it doesn't make sense to compare the absolute value of an inventory level or a cash position in one firm that's significantly smaller than another firm. So what they do typically is what's called common size balance sheets, and that is to say you reduce the balance sheet instruments entries to percentages. So the common size balance sheet is and the common size income statements are exist as a percentage of assets in the case of the balance sheet, or as a percentage of sales in the case of the income statement. And this way you're able to look at the various ratios and the various comparisons between firms in a fairer way, in a more equitable fashion. There are five various main categories of ratios, and they include short-term ratios or solvency ratios, which are also often called liquidity ratios. The second area is long-term solvency or financial leverage ratios. The third category is asset management or turnover ratios. The fourth are profitability ratios, and then finally the fifth category is market value ratios. Table 3.5 in your textbook is a summary of all the common financial ratios. And again, they're listed by category, and within the category they have the formulas for each of the ratios. So under the short-term solvency or liquidity ratios, we have, first of all, the current ratio, which is simply the fraction that's represented by current assets divided by current liabilities. What kind of current ratios are you looking for? Well, people who want to lend you money, people who want to extend you credit, hope that your current assets are greater than your current liabilities, because this is an indication that you might have enough money available to pay your bills. And so that's why it's called a solvency or liquidity ratio. However, if this ratio while we like to see it greater than 1 in most cases, if it's too much greater than 1, is that a good thing? Is a current ratio, say of 5, where you have 5 times more current assets than you have current liabilities, is that necessarily a good position to be in? Well, it might be good for somebody willing to lend you money, but it may not be the optimal idea for you as an individual. In fact, likely it's not. If you have too much money in current assets, you're probably hurting your overall profitability. The reason for that is, if you take a look at things like CDs and money markets, the money market or the very short CD pays the lowest rate of return, right? Whereas the longer term investments like bonds of 20 years or the difference between borrowing for a long-term asset or a short-term reflects the notion that the longer the duration of the financial instrument, typically the higher the rate of return that's required by investors, and the higher the rate of return the asset earns. And so if you have all your money and all your assets tied up in short-term things, you're probably sacrificing returns. You could be getting higher returns by having more long-term assets. The other thing that a lot of lenders will look at is what's called a quick ratio, sometimes called the asset test. And what that does is it subtracts from current assets inventory. So it's current assets minus inventory divided by current liabilities. The reason for subtracting out inventories are that maybe a large portion of your current assets are tied up in inventory items, and maybe some of that inventory is shop worn, needs to be marked down in order to be sold. Maybe it's out of date, maybe it's obsolete, maybe it's just slow moving items, things that don't sell quickly. And so while it's considered, inventory is considered a current asset, not all inventory is equal. So oftentimes firms will look at the quick ratio and subtract out inventory from current assets. The final liquidity measure is the cash ratio. The ultimate liquid investment is cash. So if you divide your cash balances by your current liabilities, you get the cash ratios. Well, looking on a little bit longer term now, we have some long-term solvency and long-term what's it called, financial leverage ratios. They include the total debt ratio. Total debt ratio is just total assets minus total equity divided by total assets. So this really is a measurement of what's called capital structure. What percentage of your firm on the right-hand side of your balance sheet is does liabilities or does debt make up? So if you have $100,000 worth of assets and 50,000 of it is equity, owner's equity in the form of shares of stock or owner's equity, and the other half is borrowed money, bonds say, then you have a 50% debt ratio. And the greater the debt you have, the higher your leverage is. And with greater debt comes more risk. And with higher risk, you hopefully have higher returns. But higher risk also means that sometimes unfortunate things result as well. A turn down in business or a adverse event takes place and your income drops precipitously, and yet you still have debt to pay or interest to pay on your loans. Your company stands risk of becoming insolvent. Continuing in the long-term solvency or leverage ratios, the debt minus equity ratio is simply total debt divided by total equity. And the equity multiplier is total assets divided by total equity. These three ratios are very similar. They're actually just rearrangement of the three individual numbers in the original equation. Times interest earned ratio, that's earnings before interest and taxes divided by the interest payments. Banks often look at this as a measure of how likely it is you'll be able to make the interest payments on your loans. And so this is a common sort of ratio that banks want to look at. Cash coverage ratio essentially takes the earnings before interest and taxes and adds back in depreciation, because remember, depreciation is a non-cash item, and therefore your cash coverage ratio is actually a little better than your times interest earned ratio, because it includes the fact that the non-cash item of depreciation, while an expense for tax purposes, really doesn't represent a cash outflow. The third category of ratios are asset utilization or turnover ratios. These are measures of efficiency of how well you're using your assets. The inventory ratio is the cost of goods sold divided by inventory. That is to say, do we turn over inventory 12 times a year, 3 times a year? Obviously, the faster we turn over our inventory, the better it is, because you don't have large inventories that are costing you money to finance and store. On the other hand, though, if this turnover ratio is so high that in fact you're missing sales because of stockout situations, you need to come to terms with that. This is where that famous EOQ model that calculates the optimal order quantity and inventory levels becomes very useful, because too much inventory, while you won't have the risk of stockout situations like you would with lower inventory, also carries it has higher carrying costs, and therefore might not be optimal for your firm. Days sales and inventory. If essentially you take your inventory ratio and divide that into 365 days, you'll find out how many days your average sales are represented by inventory. Receivable turnovers, sales divided by accounts receivable. How quick do you collect accounts receivables and turn around and lend that money out again on new sales? Payables turnover, cost of goods sold divided by accounts payable. Days sales in receivables, 365 divided by the receivables turnover ratio. Days cost in payables, divide your payables turnover into 365. Total asset turnover, sales divided by total assets. And then finally, capital intensity, total assets divided by sales. In other words, how many dollars of assets do you have to have in place in order to make a dollar sale? Capital intensive organizations might have much higher ratios than say a online brokerage firm that sells goods that somebody else holds and fulfills for you. The next category is one that we focus on a whole bunch in finance and individuals as well. Profitability ratios. Essentially, the profit margin ratio is your net income divided by sales, and that gives us a measure of what percentage of our sales are represented by profit. Return on assets, ROA, net income divided by total assets. That is to say, when we invest money in assets in this firm, what kind of return are we getting on them? And then return on equity, which is total equity divided into net income, i.e. for a dollar's worth of investment, ownership in the company, what are my returns? And then it's also true that you can relate all of these things. That is to say, the return on equity is equal to the net income over sales times the sales over assets times the assets over equity. Again, looking at another way of decomposing the return on equity. Finally, there's what they call the market value ratios. The price earnings ratio is essentially the price per share divided by the earnings per share. Oftentimes, people look at what are called PE ratios, price earnings ratios, as a indicator of how well a firm is doing compared to other firms in their industry. By the way, if you don't have earnings, guess what? You don't have a PE ratio. So you don't calculate negative PE ratios. So that measure is often cited in analysts' reports of firms that we might be considering to purchase, and we might look at average PE ratios in a given industry and say, is our company doing better or worse than that? The price to sales ratio is essentially the price per share divided by the sales per share. The market to book ratio looks at the market value per share divided by the book value per share. If you see a market to book ratio where the book value is less than the market value, what does that tell you? Well, it tells you probably because of historical costs that the value of your assets and your potential for the future are greater than what you're carrying them on your books for. If, on the other hand, if your the market value per share is less than the book value per share, that means that the market isn't valuing your assets even at historical costs, i.e., they don't think much of your either your accounting or your potential for the future. However, takeovers often happen like this, and if that were the case, that truly you could buy the company less than the value of it, the book value of its assets, that might be a company that's slated to be purchased and liquidated for a profit. The last ratio in this table is the enterprise value divided by earnings before interest, taxes, EBITDA. So those are the major financial asset ratios that the textbook talks about. And finally, they also look at another ratio that's often calculated called the DuPont ratio, or the DuPont identity, which breaks your return on equity into three parts. How many of you remember from taking Latin? Gallia est omnis divisi in partes tres. That is to say, Gaul is a whole divided into three parts. Well, much like that famous Latin phrase, return on equity is also divided into three parts with the DuPont identity. And it says the return on equity is equal to your profit margin times your total asset turnover times your equity multiplier. That is to say, operating efficiency, asset use efficiency, and financial leverage all have an impact on your return on equity. Then the last group of ratios that talk about are your dividend payout ratio and your retention ratio. The dividend payout ratio is equal to the cash dividends that you pay out divided by your net income. Right now, for instance, dividend paying stocks like the oil companies now that are yielding something like 4% as far as a percentage of stock price, but they're as a percentage of net income, it's actually much higher than that. Retention ratio looks at any additions to retained earnings divided by net income. That is to say, when you earn $1, how much of it do you keep in the firm as in the terms of retained earnings, and how much of it do you pay out in dividends to your stockholders? And essentially, the greater your retention ratio, the greater your potential for growth is without having to resort to external financing, because you retain more of your earnings. Some firms that are in growth mode pay no dividends. That is to say, they retain 100% of their earnings. And while it's true that the only way you can get cash from a company is through dividends, investors are willing to accept that because the potential for higher dividends down the road appears to be great. And so they're willing to forego dividends today for the potential of higher dividends down the road. So your dividend payout ratio essentially um, means that it's the ratio that determines your internal growth rate. Your internal growth rate means how, at what rate can you grow without any external financing. And essentially, your internal growth rate is equal to your return on assets times your retention rate divided by 1 minus your return on assets, that is, the reciprocal, times the retention rate. And then your sustainable growth rate says at what rate can we grow with no new equity but maintaining our debt to equity ratio. If you have no external financing added, eventually your equity grows because your debt gets paid down. And so the sustainable growth rate says if we maintain our current capital structure, i.e. the same ratio of debt and equity, i.e. as we pay down old debt, we borrow new money. Okay, that's our sustainable growth rate. So we have an internal growth rate that says no external financing in terms of either adding debt or equity, and then we also have our sustainable growth rate, which tells us how fast can we grow and what's our potential maximum growth rate if we maintain our current debt to equity ratio. Well, that's kind of a flyby for the first 3 chapters. Again, you've got a quiz eventually for Unit 2 on this material, and your discussion boards, hopefully you're well into those, and along the way you're also going to need to consider the fact that there'll be a final project due in this course. By week 3, you need to give me an idea about your final project. Let me just read a bit from your syllabus. You're supposed to pick a business you'd like to start and show a 3-year projected income statement. You will need to make estimations of revenues and expenses. You can use the internet, talk to business owners, and so forth to make your projections. Be as accurate as possible with your projections. That is to say, revenues for your products or services, expenses such as rent, salaries, supplies, utilities, etc. should be as accurate as possible. In the past, students have chosen various businesses such as daycares, bakeries, restaurants, towing companies, candy stores, and so forth. So, as an entrepreneur, you need to do a startup business and then project a 3-year, show a projected 3-year income statement. Or, instead of doing that, you can also substitute a capital business decision at work, showing the same type of information. In the past, students have done projects showing how financials are impacted by changing the flow of revenues or expenses via production changes, new product offerings, and so forth. That is to say, if you're currently working somewhere and you have a capital budgeting project that's about to be undertaken or you're contemplating, you can do the analysis of that budgeting problem with as your final project. That is to say, you could do 3-year projections of the impact that this project or capital budgeting purchase would have on your firm. Finally, it says the project will consist of an executive summary, which is 7 to 10 pages in length, describing your new business or work project, and then a projected income statement also has to be attached. So you need to write up a 7 to 10 page executive summary of your new business. What sorts of things would be in there? Well, if I was doing this, I'd tell you why I chose a particular business or what this project hopes to do for my company. I would want to look up existing companies in that industry, maybe try to find out what some of their current ratios are, and make those perhaps targets of mine that I want to consider. I talk about how I'd finance this project. Where would I get the money? Would I do all equity? Would I borrow some money? What would my source of income be for this? Or my source of startup capital be for this business? How would I go about it marketing? What niche would I attempt to enter or control? What distinctives would I offer that would make my company different than everybody else out there? And how would I go about developing my value proposition that would make my company successful. Um, I talk about size and scope, location, different things of that nature. Finally, you have to add a PowerPoint presentation with somewhere between 5 and 10 slides and submit it on the discussion board. And then you will also comment on at least two other students' final presentations. Since we're not a face-to-face class, you won't have to actually make the presentation, but you might think of what you might do in a face-to-face presentation as you design your PowerPoint slides. And then lastly, typically in a face-to-face class, I begin the class with a short devotional and prayer. And since we're not meeting face-to-face, I did want to make this offer, and that is to say, at my point in life where I'm not full-time employed, even though I'm full-time busy, and I have some time, I have some margin in my life, and I count it a privilege to pray not only for the people in my life and my family, but for my students as well. So if there's something going on in your life that you think you'd like to have somebody pray for, shoot me an email, give me a call, get a hold of me somehow, and I count it a privilege to pray for you. And in closing today's presentation, I'd like to pray for this group as a whole. Father, I want to thank you for this opportunity we have to spend this time together, and for the effort these students are making in making the most of the talents and abilities you've given them. I pray, God, that you'd give them the strength to handle all the various challenges. I know it feels like everybody wants a piece of their time somewhere along the line, with work responsibilities, family responsibilities, and now this very intensive course that's going to require a claim on their time as well. God, just protect them and help them to have the energy and the strength to accomplish all the things they need to do. Help them to sort through their priorities and things they need to be aware of. And I just pray for their health and for their families as they support them in this effort. So God, I just pray for these students and ask that you'll be with them, and thank you for the time we will spend together tonight. For I pray all this in your name. Amen. Good night, students. Talk to you next week.